What's the risk of the Fed cutting rates too soon? Could that actually be worse than waiting too long? Considering today's jobs numbers and what history has taught us, the consequences could be quite severe. We're going to take a look at today's numbers, the Fed futures reaction to this number, and what the future has in store for us. Today's non-farm payroll was not a great surprise. We see we're trending for quite a while in the same area. Today's numbers are 275,000, exceeding the prior month of 229,000. It's a little bit above expectations, but not really any surprise. We see non-farm payroll in the private sector. It's a very similar chart. We haven't seen a lot of movement. Today's number, private sector, 223,000 new jobs were created, exceeding the prior month of 177. Overall, the private sector jobs are rising. That's good. We see non-farm payroll services also trending a little bit higher over the past month or so, 256,000 compared to last month's 205, not exceeding the prior month's 257. Very close though. Given that we're a service-driven economy, certainly it's good that this number is rising. Non-farm payroll government, not really a big sector, and conversely, it's also not really moving that much either. 52,000 new jobs, same as last month as well. No news here. The one troubling spot of this report, though, is a non-farm payrolls goods sector. That's the number of jobs created specifically in the goods region. We've seen weak consumer goods numbers lately. Today's number, 19,000. This is the lowest low we've seen in the past 4 months or so. And it's a little bit troubling if we take a look at the goods sector within our historical point of view. We can see going back to the year 2006, 2007, the white lines, the federal funds rate, the bars are non-farm payroll goods. In particular, notice we had mid '06, and this is before we knew anything about the financial crisis that ensued in the years that followed. We had months of 68,000, 36,000, 59, and then all of a sudden a drop to negative 33,000. Today's number is positive, but it's barely hanging on to positive territory, and it looks like it's trending lower. Is this an ominous sign of maybe what's to come? It's one piece of evidence, but we're going to have to keep an eye on this. In terms of the Fed funds futures, the blue bars represent the chances in the May meeting that the Federal Reserve will cut rates, going down to the 5.25 range. The yellow line represents the chances in the May meeting the Federal Reserve will not cut rates and keep us at our current 525 to 550 level. We can see going back to the beginning of February, this was last non-farm payroll report. We had a little bit better, probably around a 55% chance the Federal Reserve was going to cut rates in May. This was as of the beginning of February, 1 month ago. Well, we can see since then, the odds that the Fed will cut rates, the blue bars have gone down. At this point, the yellow line has risen to an extent. We still had a little bit better than a 50% chance of a Fed cut in the mid part of February. That was, of course, associated with our consumer price index. The CPI number told us and told the Fed that the chances that we're going to cut rates that decreased to some extent. Not as much of a reason to cut rates. Now, today's report, non-farm payrolls, we've certainly have trended to the upside in the chance that the Federal Reserve will not cut rates. The yellow line shows us the probability in May the Federal Reserve will not cut rates, and now that is above 75%. So despite a tepid number, again, it was not a huge surprise. It wasn't a huge disappointment or shock to the upside. But the fact of the matter is, in the May meeting, most likely we're not going to see a rate cut. Now, with that said, let's go back in time again to the year 2007. The white line represents the Fed funds rate. Now, the CPI, that's the Consumer Price Index, also our measure of inflation on a year-over-year basis. Now, again, the question is, what happens if the Fed cuts rates too soon? Well, we can see in October of '07, the Federal Reserve started to cut rates. At the time, we had a 5.25 interest rates. Well, they started to cut rates. Take a look at what happens to inflation. Maybe a lot of people would argue they cut rates too soon. Inflation skyrocketed. You see, when they cut rates, it's done to stimulate the economy. But if they stimulate the economy too fast, too much, well, that's contrary. And that's that's what the risk is here. That's what the Fed, I think, is really concerned about. And then it's the same period of time, the white line shows us the inflation rate from 1.9 to 4.4 to 4.9%. Inflation rate starts to skyrocket. And then what effect does that have to jobs? Jobs go to the downside. During the same period of time, first, the Fed cut rates too soon. That's what many would argue. As a result, inflation rises. Number two. Number three, as a result, the economy weakens under the weight of all that extra inflation, and we see jobs chop from 116,000, 105, negative 71, negative 219. Certainly, there were other factors at play, the banking crisis as well, but this certainly did play a part in it as well. Now we see here present day non-farm payrolls in blue, CPI, consumer price index in white. And this is really the careful balancing act that we're straddling over here. We currently have last CPI report 3.1% inflation rate. We have a 2% target. The Federal Reserve, as lately as this week, has told us we want to see an average CPI around, or average inflation rate, we should say, around 2%. But the balance is we want to do that as long as the jobs market does not fall apart. Is it falling apart? At least not today. 275,000 jobs created. So we were really straddling, the fence over here. If we see the inflation rate rise and jobs stay where they are now, the Fed won't cut rates. What will happen if what will cause the Federal Reserve to cut rates? If we see the jobs market really fall apart, that could compel, but that's not happening quite yet. We want you to tell us what you think. Vote on our poll. Given the current state of inflation and jobs, what should the Fed do? Should they not cut rates until they hit their solid 2% target? Should they cut rates in May? The economy is weakening right now. Do not cut, but be flexible. Maybe a 2.5% inflation rate. Maybe that's appropriate. Or is there something else we haven't considered? Simply go to our YouTube page and click on the community tab, vote on our poll. It'll be very interesting to see what all of you have to say. We thank you for joining us. We look forward to seeing you back soon.